Welcome to FM with Sir Evans. In today's session, we will discuss the part 2 of the 6th competency in the syllabus of ICA Paper 2.4, Financial Management. Let's get started. We are starting off with management of receivables and payables. So how do receivables or payables come to be? So often, standard credit terms are applied for most business transactions, such as 30 or 60 days from the date of the invoice, and the customer is assumed to pay after that period. So there are some benefits of giving credit. There is increased sales volume. We can also stay ahead of the competition. However, some costs are also borne by the entity. So some of them include one, the finance cost. That is, there is higher investment in working capital if the credit period is bigger. The cost is item in the period times the cost of capital. Now we have the bad debt cost. So the customer may never pay for the goods supplied, and administration costs, which is the additional cost to negotiate for these terms that we give to the customers. And in managing trade receivables, it involves a system of deciding whether to give customers credit and how much credit to give them. You would also be monitoring the payments, and you will collect overdue payments. So giving credit, this decision is largely based on whether the customer has paid promptly in the past. So you need to perform certain credit checks. So some of them include asking for trade references from other suppliers who the customer might have dealt with in the past. You can also ask reference from the bank. You can also discover whether any court judgments have been made against the customer for non-payment of debt. So credit checks on small businesses can be purchased from credit reference agencies. And for business customers, you can ask for recent financial statements if the credit you're about to give them is quite huge and significant. You can also use reports about apparent condition of the business of the client from the company's salesmen who often interact with them. And that will give you a background of whether you need to engage into a credit arrangement with a customer or not. So usually a company establishes a credit policy which guides how they need to give out credit to customers. And the limit is often reviewed if the customer pays the invoices promptly within the credit term. So there are certain elements of the credit term. We have one, the credit period, which is the customer required to pay invoices within a stated number of days. 30 to 60 days are common. We have the credit limit, which is the maximum amount of credit that the customer will be permitted. And small initially is small, but then it increases with time. And there is also interest charges on overdue payment, which is charged for late payment and may push the customers to rivals. So credit checks on individuals should be carried out. Most companies give credit to corporate clients. And monitoring payment. So there is an age debtors or age receivable list, which is produced and lists all unpaid debts and those which are overdue beyond the given credit period. So it shows how much is owed by the customer and for how long the money has been owed. So the receivable team will then follow up for payment and assess the collectability. So procedures for efficient debt collection include you sending invoice to customers promptly as soon as the goods or services have been provided. And you can also send regular statements to credit customers, showing how much they owe in total and those due for payment. The third one is ensuring that credit terms are not exceeded and the customer is not allowed to take longer credit. So to chase overdue payment, you can make telephone calls, send reminder letters. You can even withhold further suppliers and further credits. Where extreme, you can use debt collection agencies, send legal notices, threats from solicitors, and finally, you can even take legal action. But this is often for the last resort, as it may hamper the relationship with the client. So bad debts, they arise due to credit granted to customer, and they have a direct impact on the profitability. So to reduce this, there should be more extensive and careful credit checking procedures. There should be more efficient collection procedures and reducing the amount of credit in total. But this may reduce sales, hence gross profits. Debt factors and invoice discounting. So debt factors are specialist organizations who assist firms to administer their trade receivables ledger. So they also provide short-term finance to client firms, and this is secured by the trade receivables, and they provide insurance against bad debt. So their services are often useful for SMEs that has large credit customers, and there are inefficient debt collection procedures and inefficient working capital finance in these entities. The main services provided are receivables administration, credit insurance, and debt finance. Now, trade receivable administration. So they send out invoices on behalf of the clients and indicate their role. They ask for payment to be made to a bank account and chase late settlers. They also make inputs in the receivables ledger. They charge an agreed percentage of the value of the invoice that is sent out. Credit insurance, they know without recourse or non-recourse factoring, and the factor pay full amount of unpaid invoices. So invoices must be approved in advance. And factors also provide with recourse factoring where they don't pay unsettled. Then debt finance, they advance up to 80% of receivables face value for those approved by the factor. So this is provided at an agreed rate of interest and repayable when customers make payments. Now, there are certain costs of factoring which consists of the service fee, commission charge, and any interest charges which may be borne by the entity. There are certain benefits of using a factor. So there will be savings in internal administration costs since the factor administers the trade receivables ledger. With non-recourse factoring, there is a reduction in the cost of bad debt, and factor is also a source of finance for trade receivables. However, there are certain disadvantages. There is higher interest charges than other sources of finance. Customer goodwill may suffer as the factors may not treat them well, and it may also be a sign of financial weakness. Hence, it affects the entity's reputation. So when we are evaluating a factor service, we assess the cost of using the factor. We consider the cost of receivables ledger administration, any bad debt which we've incurred over the period, and financial costs for the trade receivables. Invoice discounting. So an invoice discounter provides finance against only a small number of selected invoices and would not administer the trade receivables ledger like the debt factor. Settlement discount is a policy to reduce trade receivables by offering a discount for early payment of an invoice. It's also called early settlement discount or cash discount. Example, the company might offer normal credit terms of 60 days, but a discount of 2% for payment within 10 days of the invoice date. In evaluating a settlement discount, the benefit is that it reduces average trade receivables, and this reduces the annual interest cost of investing in trade receivables. Discounts taken by customers reduce the annual profit. Evaluating a proposal to offer settlement discount involves comparing the improvements in cash flow and reduction in interest costs with the cost of the discounts allowed. The implied interest cost of settlement discount. So one way of evaluating is to calculate the implied interest cost of offering settlement discount. So there is this formula, which is the cost of a settlement discount being equal to 1 plus d over 100 minus d, all raised to the power 365 over t. Then all of these minus 1. So d refers to the size of the discount. T refers to the difference in days between normal credit terms and the maximum credit period for taking advantage of the settlement discount. So there is an example here. Suppose that a company offers its customers normal credit terms of 60 days, but a discount of 2% for payment within 10 days of the invoice date. So for this question, when you put it in the formula, our D there will be 2. So that's the discount, the 2% that is being given. And then our T is going to be 60 minus 10. So 60 days being the normal, and then 10 days being the additional when you take advantage of the settlement discount. So T will be 60 minus 10. So when you put it in the formula, you'll be having 1 plus 2 over 100 minus 2. So it will be 2 over 98. And 365 over 60 minus 10, so 365 over 50. And mind you, the negative 1 is outside of the whole equation. It's not with the 365 over t. So when you do it, you'll be getting a cost of settlement discount of 15.66%. In calculating the total annual cost, an alternative method of calculating that is you are comparing this with a policy of not offering discounts. and it will be to compare the total annual cost with each policy. And that can also help you in making a decision of offering a settlement discount or not. Okay, so we'll now be looking at the management of trade payables. So trade credit allows the buyer to hold or make use of goods obtained from the suppliers without yet having to pay for them. It therefore postpones the need to find the cash to make payment for goods and services purchased. Unlike other sources of finance, including a bank overdraft or a bank long trade credit does not have any cost. A company should therefore take advantage of the trade credits it is offered and negotiate the best credit terms that it can get, because it's a free source of finance for working capital. However, it should not exceed the amount of credit that is being allowed. Settlement discounts from suppliers. So the value of a settlement discount from a supplier should be assessed in the same way as the cost of a settlement discount to the customers. If the value of taking the settlement discount is higher than the cost of having to finance the payment by the bank overdraft, the discount should be taken and the trade debt should be paid at the latest time possible in order to obtain the discount. So we have an example here. Example is Purple is offered a 2% settlement discount if it pays invoices from supplier X in 10 days rather than after the normal 30-day credit period. It can borrow on its overdraft at 12% per annum. So with this example, we'll be using the cost of settlement discount formula. And then with this one too, the discount is 2%. The T is going to be 30 minus 10. So it is 10 days rather than after the normal 30-day credit. So it's going to be 1 plus 2 over 98 raised to the power 365 over 30 minus 10. All of this minus 1. And this will give you 4.6%. So we move to cash management. So there are certain reasons why we hold cash. So one, we want to settle transactions. That is, cash is needed to pay for expenses and to settle any debt. Also, we hold it as a precaution against unexpected and unforeseen requirements for cash. So we also hold it for speculative reasons. That's a company holds cash that can be used if a business opportunity arises. However, cash does not earn a high return. Holding cash therefore provides a company with liquidity, that's an ability to pay, but it reduces profitability. That is the lost income that results from holding cash rather than investing it in a business development. So, however, there are some objectives of good cash management. You should hold sufficient cash so you can meet liabilities as they fall due, while making sure that not too much cash is held. Surplus cash must be invested in short-term financial instruments or even savings accounts, and so can earn some interest. So there are certain aspects of cash management. We are forecasting cash flow requirements and operational cash flow, deciding how to invest surplus cash in short-term investment, and also deciding how much cash to keep and how much to invest in the short-term investment. Those are certain aspects of cash management. How about cash budget? It's a detailed plan of cash receipts and cash payment during a planning period. So for an annual master budget, the cash budget might be prepared on a monthly basis or possibly a quarterly basis. So main uses of cash budget are: one, to forecast how much cash receipts and payments are expected to be over the planning period, to learn whether there will be a shortage of cash at any time during the period. If there's a forecast shortage of cash, you should consider certain measures in advance from dealing with the problem. And then to monitor actual cash flows during the planning period by comparing actual cash flows with the budget. How do we prepare a cash budget? So a cash budget can be prepared by producing a table for the cash receipts and cash payments, containing each item of cash receipts and cash payment. And the cash receipts and the cash payment will be listed in the rows of the table, and each column of the table represents a time period, such as 1 month. And that will help us to come out with a surplus or deficit at the end of each month. Okay, so cash flow forecasts, how different are they? So these ones are used to predict future cash requirements or future cash surpluses. However, unlike cash budgets, these cash flow forecasts are prepared throughout the financial year, are not part of a formal budget plan, and they are often prepared in much less detail than a cash budget. The main objective of cash flow forecasting, like what a cash budget also does, is that it makes sure that the entity is still expected to have sufficient cash to meet its payment commitment as they fall due, and also identifying the period when there will be a shortage in cash resources so that financing can be arranged. Also identifying whether there will be a surplus of cash so that the surplus can be invested, and assess whether operating activities are generating the cash that is expected from them. The main focus of cash flow forecasting is likely to be operating cash flows, although some investing and financing cash flow might also be significant. So there are certain techniques for preparing a cash flow forecast. There are no rules and must not be in the same amount of detail as cash budget. However, two basic approaches are used. You can produce a cash flow forecast similar to statement of cash flow prepared using the indirect method. And you can also forecast cash flow by estimating revenue and cost to arrive at an estimate of EBITDA. That's earning before interest and tax, depreciation and amortization. Okay, so what are free cash flows? So it's the amount of surplus cash flow after allowing for all cash payments that are essential and non-discretionary. So the free cash flow is equal to EBITDA minus, into bracket, we have our interest payment, tax payment, changes in working capital, and essential capital expenditure. We'll move on to certain cash models, and the cash models are used to decide how much cash to hold and how much to invest in short term so we can earn interest, and when cash is needed, how many investments we need to sell. So we'll start off with the first model, which is the Bowmore model. So the Bowmore cash model is based on similar principles to the EOQ model used for inventory control. It assumes that a company spends cash regularly on expenses, and that to obtain the cash, it has to sell short-term investments. The purpose of the Bowmore cash model is to calculate the optimal amount of cash that should be obtained each time that the short-term investments are sold. And certain assumptions that are used in the model are: one, there should be constant usage rate. That's the constant, the company uses cash at a constant rate throughout the year. The company can replenish its cash immediately as soon as it runs out of cash it has. And cash is replenished by selling short-term investments. That's ex-Ghana CD, and holding cash comes at an opportunity cost. So that's the CH, holding cost, and selling securities or investments to obtain cash has a transaction cost. That's CO, ordering cost. So the maximum amount of cash is X, and the average cash holding is X over 2, and annual cost of holding is X over 2 times CH. So if the annual demand for cash is D Ghana cedis, then the annual transaction cost for selling securities is D over X times CO. So you can relate this to the inventory EOQ model that we looked at in the previous session. So the model identifies the optimal amount of cash to obtain by selling securities. X is the amount of cash that minimizes the total opportunity cost of holding cash and the transaction cost of selling securities. The total of X over 2 times CH plus D over X times CO is minimized where X is equal to square root of 2 COD over CH. Okay, so we move on to look at the Miller-Orr model. So Miller-Orr model recognizes this uncertainty in cash flow, which are measured statistically. So daily cash flows might be positive or negative, and the net daily cash flows are then assumed to be normally distributed around the daily average net cash flow. So Miller-Orr model formula for the size of the spread is equal to 3 times, bracket open, 3 over 4 times the transaction cost times variance of cash flows all over the interest rate as a proportion, all of this raised to the power 1 over 3. So certain notes to be mindful of: 1, the transaction cost is the cost of the sale and the purchase of security. The variance of cash flow is a statistical measure of the variation in the amount of daily net cash flow. To convert an annual variance of cash flow to a daily variance, you need to divide it by 365. And you also remember that a variance is the square of the standard deviation. So the value of the power of 1/3 means the cube root. So that explains the spread for us. Okay, so we go ahead and take an example. Entity ASD decides that it needs a minimum cash balance of 15,000 Ghana cedi. He estimates that it has transaction costs of 50 cedis for each purchase or sales of short-term investment. Based on this measured historical observation, the standard deviation of daily cash flow is 1,400 Ghana cedi. The annual market interest rate of short-term investments is 8%. So we are asked to calculate the upper cash limit and the return point using the Miller-Orr model. So we start off with the variance of the daily cash flow. So it's equal to 1,400, which is the standard deviation of daily cash flow raised to the power 2. And that gives us the 1,960,000, giving us the variance of the daily cash flow. Now the daily interest rate is equal to 0.08. So we see the annual market interest rate of short-term investment is 8%. So the daily will be 0.08 divided by 365, giving us 0.000219. So when we use the formula, we'll find that the spread will be equal to 3 times. So 3/4 times 50 times 1.960,000 all over 0.000219. All of this raised to the power 1/3. So we'll find a spread of 20,840. So the lower limit, which has been decided by management, also known as the minimum cash balance, is the 15,000. The upper limit is going to be the 15,000 plus the spread, which is 2848, to give 35,848. Now the return point is 15,000 plus 1/3 times the 2848 to give 21949. So then we'll be having a return point of 21949, upper limit of 35,848. However, we can also alternatively calculate the daily interest rate to be 365, which is a root of 1.08, which is the 8 being the short-term investment rate, to give 0.000211. So when we use that same formula, the spread will be 21,108. Our lower limit being 15,000 and our upper limit being the 15,000 plus the spread. So other aspects of cash management. So we need to consider the use of surplus cash. So when a surplus is identified, the entity should plan how to use it. Holding it as cash is wasteful because cash in a business bank account earns no interest. If surplus is likely to be long-term, then the cash should be invested in long-term wealth-producing assets of the business or be paid as dividend to the owners. Whereas where the surplus is temporary, we can consider investing it in short term. But then we need to consider, one, the liquidity. It should be convertible into cash fairly quickly at a fair price and without difficulty when we need it. And you should also think about the safety. So the level of investment risk should be acceptable with no risk of capital loss. And for the profitability, it should earn highest possible return on the surplus cash, consistent with the objective of liquidity and safety. So there has to be a trade-off. The greater the liquidity and safety, then generally the lower will be the interest rate that is earned profitably. Now, some ways of investing short-term. So possible short-term investment options for cash are, we will have a savings account and an interest earning deposit. We could also consider money market investments such as treasury bills, certificates of deposit, short-dated government bonds, and also longer-term securities could be bonds and equities. So how do we deal with shortfalls of cash? So long-term funding by issuing new shares for cash or borrow long-term. And also for the short-term sources, we could also have bank overdraft, short-term bank loans, and debt factoring. Okay, some other aspects of cash management. We have a treasury department. So cash management in larger organizations, this is often handled by a specialist department known as a treasury department. So it centralizes the control of cash by so cash will be used as efficiently as possible. Surplus in one part of the business will be used to fund shortfalls elsewhere in the business. And surpluses are suitable, invested, and matured when cash is needed. Now, making the management of cash the responsibility of the centralized treasury department has certain advantages. So cash is managed by the specialist staff all cash surpluses and deficits from different bank accounts used by the entity can be pulled together into a central bank account. It also lowers the amount of cash needed for to be kept for precautionary reasons, and putting all the cash resources into one place increases the negotiating power. Then we'll also look at some functions of a treasury department. So producing regular cash flow forecasts to predict any surpluses and shortfalls, arranging short-term borrowing and investment when necessary, arrange to purchase foreign currency when needed, protect the business against the risk of adverse movements in foreign exchange rates, and deal with the entity's bank, finance the business on the day-to-day basis, advise senior management on long-term financing requirements. So these are some functions of a treasury department. I'd like to thank you for staying with me till the end. Kindly follow the link below to join the channel created for Paper 2.4 Financial Management. You'll be able to access the slides, market marking scheme to the examples I discussed, and other relevant material to aid in your preparation for the exam. I would like to thank you once again, and I'll see you in the next session.